I have some exciting news. You only need 5% now to get a conventional multifamily, which is crazy. Before, that was only for FHA. If you were doing conventional, you had to put at least 15 to 20% down. 15% if it's a 2-unit, and 20% if it's 3 to 4 units. And 4 units was the cap. If it's 5, you now have to go to commercial where you need to put 25% plus down. Now the doors have been open. Those limits have been lifted, because part of the reasons why I've been looking more in South Jersey, because I was trying to get a secondary FHA, move somewhere else, right? That becomes now my primary residence, and I rent out the rest of them. If I wanted to do this on a low down payment, if I wanted to do this next door, if I found a property next door, I had to put 15% down if it's a 2-unit, 20% down if it's a 3 to 4 units. The restrictions have been lifted by God's grace. So looking at this right now, for a single family, a loan to value ratio, you still have the flexibility of putting 3% down if it's your first residence. This is your first purchase that you're doing. But if it's your second, you have to put at least 5% down. That's why they have this 95% loan to value ratio is. Whenever you see loan to value ratio, meaning the loan amount is 95%, and the percent that you're putting down is 5%. For the first one, the loan to value is 97%, and you only need to put 3% down. That's only applicable to, again, your first time residents. This is also listed for the Home Ready. So what the Home Ready program is for people with like lower credit scores. They don't have the higher credit scores. And you got the Home Style Renovation. This is the equivalent of the 203K loan on the FHA side, which also is applicable to that, as well as if you had to refinance, which I don't see anybody doing right now. If you had a low rate at like 3.5%, 4%, you're golden compared to the 7.5%, 8% rate that you're going to get right now. And who knows, by the time this comes out, this launches on November 18th, right? This is not for right now at the time that you're probably seeing this video, but on November 18th, if you're seeing this video after then yes, this is in effect. I don't know how things may change depending on the amount of underwriting that goes through. If it causes the market to affect in any type of way, then I see these rules potentially changing. But right now, this opens up a lot of door for people who always complain about, I'm one of those, man, like who just leaves $120,000, $150,000 just sitting around and put 20% down on a home in areas like this, right? That just really makes no sense. The property could cash flow on its own with just me renting out 3 units with just a low down payment. Like if I could get an FHA next door, I would have done it a long time ago, but I couldn't do that because I already got the infrastructure, the mechanism down packed in terms of running a property. The lower down payment, I could understand. It poses a more risk situations, but with nowadays, as people are getting smarter, playing with loans, like using other people's money, could help keep the economy flowing, keep the economy going, and open up a lot more opportunities for much more people. And I think they've realized that, which is why they've expanded to do these loans. So we're going to take a look at another article which breaks this down a lot more, right? Key takeaways, right? It's 95% loan to value ratio for 2 to 4 units. 4 units is the cap. Anything above that, you got to go to the 25%. Can I qualify with the potential rental? Yes, you can. Similar to FHA, they have something called the self-sustaining rule with FHA, and I'm going to show you the numbers, how that works. Pretty much what they said is if 75% of the total rental income for that property can pay the mortgage, insurance, and everything, then it qualifies for the FHA multifamily, right? So they're allowing for the same thing to happen. I'm not sure yet if it's going to be the same thing, like if they're going to use the 75% rule as well. And 620 score is all you need. And that's part of their Home Ready program, right? You possibly have to take a course in order for you to qualify for that loan. They always had that guideline. That's not changing at all. But again, your lender may have certain requirements that they are able to go through. So here are some of the common questions, right? What is the difference between a second home and an investment property? A second home is a property that's primarily used by the borrower for their own personal enjoyment, right? Like a vacation home. While an investment property is a property that's purchased with the intention of generating rental income or capital appreciation. What that means is you're renting it out completely, the whole thing. You're not living in part of it at all. So these loans, it is required that it is your primary residence now. So if it's 4 units, you staying in one, renting out 3. That's how the bank is going to look at it. They cannot look at it as you're going to be renting out 4 for the time being. You do have to stay in it for at least a year, and then you can do whatever you want. Like my home right now, it has been purchased under FHA, but after I passed that year mark, I could have went anywhere and rented out the whole thing, completely within the guidelines, completely within the rules. And one of the benefits of that is that I can now fully depreciate all the costs within the home. Right now, I can only do half because it is a 2-family. Therefore, half of it I can depreciate, as well as the expenses that I'm doing. But if you rented out the whole thing, you could write off everything and you could depreciate the whole entire property. Are there any income limits for borrowers looking to take advantage for the new 95% LTV? So far, they say there is not an income limit. I've looked at some of the numbers, especially by me. Like, I can get something 4 units under $1 million, and a lot of their caps is for like 1.4, something ridiculous like that, which is more applicable, I would say, to California, some parts of New York as well. But I don't see myself purchasing anything at that price point. For me, it just doesn't make sense. Like the rental income for a lot of these like $1.45 million 2-3 family homes, the rental income is not enough. Like if you're putting 5% down, it just doesn't make sense. What are the reserves requirement for borrowers? Because FHA has that rule as well. Like usually you have to have 6 months of reserves across different accounts. It could be an account, a retirement account. It could be stocked assets that you have, or assets that you have from a company. As long as it totals up to 6 months of the mortgage payments, you are okay. Some banks and lenders are more flexible with that, but that's typically the rule for the FHA, like 3 to 4 unit reserves, on top of the self-sufficient, sustained rule that they have, right? The reserve requirement for borrowers using the new 95% LTV will depend on various factors, such as the number of properties owned by the borrower and their overall financial situation. So you have to speak to your lender and figure that out. For me, I'm okay. I know I have 6 months, a year, times whatever across my retirement account, so this should be fine. Can I refinance my existing loan using the new LTV? Yes, you can do that. Or there's specific credit score requirements for borrowers using the 95% LTV rule. Again, 620 I believe is the minimum, but once the loan actually launches on November 18th, your lender might, want to take risk on you, or they may not, because they are the ones that are initiating that. And if they're doing things that are faulty, of course, they could get in trouble for that, lose their license. So I think it might also depend on the lender in that situation. What is the role of Fannie Mae in these guidelines? Fannie Mae sets the guideline for home financing in the United States. These guidelines provide a framework for lenders to follow when underwriting loans. So they don't actually provide the loans. They're still working with like banks and such. Like NewRez is who I pay directly for my loan right now. But I didn't go through them, right? It was some broker that I go through. They were required by FHA to follow certain rules, and that's pretty much how I got the loan. It's the same way. You're going to have brokers. You're going to have different hands in the pot. But Fannie Mae, or more like the regulators, they're kind of like similar to the FHA regulators. I mean, everything is controlled by the Federal Housing Authority at the end of the day. It's just that they have a loan called the FHA loan, but they're all subject to whatever the federal sets, right, in terms of what can be and cannot be done. Because depending on these products that they provide, it can alter the economy quite a bit. So one thing I thought about is like, once this happens, will this make prices increase? Because now you have more buyers that their problem was that they didn't have the 20% down, but now they do, and these numbers can make sense for them. Now, are we going to have more buyers in the market? Will this make home prices increase? That is a possibility completely. Or will it make people sit down and wait and be like, you know what, it's still too expensive, because now it is a low down payment, but the home prices are still crazy with the low down payment. It may not make sense. Let's take a look at a calculation real quick. So this home, this is close by me. It's in my town. It's listed at $689,000, right? So considering like a 6% seller concession, which is about $40,000. So let's put this at $730,000 total cost, right? So I'm gonna put the loan at $730,000. Down payment is at 5%. Interest rates, we're gonna buff it up a little bit at 8.5%. I don't think it's going to be that high. I think it's going to be exactly 8%. You're going to pay mortgage insurance. There's no doubt about it. Property taxes, right now for this property, it does list it at $6,900, but that's because it's at an old assessed value. If it comes to my full assessed value, it's going to be up there. Like right now, I'm currently paying a little over $12,000 for my current property, and I purchased it at $590. They assess it at $540,000 in value. So I do expect that your taxes are going to go up maybe after a year. Home insurance, I'm paying $3,600, so I buffed it up to $4,000. And the HOA fees, we don't really have any HOA fees. I just use this as a way for me to calculate like utilities expenses, because I just put it all in one place, right? $600 in monthly expenses to maintain the property. This is a 4-unit. Now, let's look at the size of this, right? Looking at the description real quick. So it's 4-family, consists of 3 2-bedroom, 1 bath, and 1 unit with 3-bedroom, 1 bath. So we already know we're going to stay in the smallest unit, right? So it looks like there's 3 2-bedroom, 1 bath. We're going to stay in one of those. And the 3-bedroom, 1 bath, we are going to rent that out. So we are at $7,921, right? I'll just keep it at $7,900 because I know I inflated a lot of these numbers. If we were to do this with FHA, right, of course, the monthly payment would be up by $200. So it's like a $200 difference from what we're looking at right now. Everything else would pretty much be the same. Nothing else would change. FHA rates is usually lower, so we could use actually 8%. So the payment would actually be the same. $7,900 both ways, pretty much. All right, so now let's look at this area. This is at 89 Boswick. So let me just look for this. We're going to see what 3 bedrooms, 1 bath go for. I know what it goes for, like around $2,400-$2,500, because I live around here. And we're going to sort by low to high, and we're going to look for the middle, so then we know what the number is, right? So yeah, like $2,300 would be the least you charge for that. We see some people listed at $2,250, right? So let's go for $2,200 just to have a safe number. And now let's look at 2 bedrooms. Let's go to the middle. All right, so 2 bedrooms will have $1,800. That's really more realistic, like $1,800-$1,900. They're definitely getting up there. And then now let's pull out our calculator to see how close are we to that $7,900 mark, right? So we have $2,200 conservative plus $1,800 times 2, because we're number 2 units, $5,800. So we're way off from our $7,900, of course, right? But what you got to think about is the extra units. If you stay there for a year, you suffer, bite the bullet for a year, and then you rent out the whole thing after the year, right? You would have another $1,800 coming to you, right? And you'll be close to it at $7,600. So of course, I inflated a lot of numbers, and we're still in a negative. The best thing to do for this is, of course, like try to bring down the price as much as you can, because at $730, it seems like you're under. You'll be in a negative. I would say if you rented out the whole thing where you're factoring these numbers, and that's only because it's close by to where I'm at, it's a little bit more convenient. So I'm willing to not make any money at all or break even, right? So it's more beneficial since I don't have to travel as much. If it's further away, I want to make sure it's worth my time to travel an hour away or more in order for me to get there. But that's kind of how you have to calculate this thing. If this thing with the 3 units was able to pay itself off or become close to it, and I stay in 1 unit like practically almost for free, then this would have been a green light completely. But this is not far away. It's just negotiating the price or purchase price lower, or ask for more credits. Well, I would suggest that you ask for a lower payment, because that way you could factor in payments lower from that perspective. Of course, you could ask for seller credit, so that way if there's any repairs that you have to do, it's kind of equivalent to you taking your own cash or getting a credit card and making additional monthly payments for X amount of time in order for you to fix those things. So you got to factor those in when it comes to asking for more repairs. So although it costs you a few $100s more a month, it's the equivalent of you getting a credit card separately and making those repairs on your own. So factor and think about these things. And So I really hope you took insights to everything I was saying today and you actually start looking for properties. I spoke to a lender and she got back to me. She said that the earliest I can possibly close is December 15th if the loan process on November 18th exactly, which is great, about 30 days from the time that I processed the loan. But of course, I got to get all the paperwork and stuff together ahead of time. They got to give me the commitment letter, and I would have already been in contract, went through inspection with the property, etc. So that's just such a game changer, and I really hope that you find encouragement to now actually look for something that's either close by you, and now you only need 5% down. You're not restricted by the 100-mile rule like FHA requires you to from your current primary residence, right? You can find something next door and able to continue capitalize on this home hacking that is available to you. So like, share, subscribe, of course. I hope you just continue to find encouragement. If you have any questions, drop it in the comments below. Let's continue to help each other build peace and love, trust in Jesus. Have a great one. Hustle, 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 stay.